Okay, I think we're in business. Sorry for the delay. Um, my topic is predictive analytics in capital markets. I want to talk about the science. I started a company about a year ago with a partner. We're off to a very good start. We're doing this science, but what I'll talk a little bit about the company at the end, but I mainly want to talk about the science, what's different. First of all, what are predictive analytics in capital markets? It's basically using a combination of data mining, artificial intelligence, natural language reading ability, processing ability, certain algorithms, et cetera, to create forecasts of what's going to happen in major capital markets categories. When I say capital markets, this is not a stock picking tool. We're talking about the euro-dollar cross rate, the price of gold, the price of oil, U.S. interest rates, the dollar-yen rate. So major currency cross pairs, major commodity prices in dollars and other currencies, and major indices. We'll look at indices like the S&P 500, but again, not necessarily individual stocks. Now, when I say artificial intelligence, people either they roll their eyes or they're like, oh yeah, everybody's doing artificial intelligence. And it's true, everybody is doing artificial intelligence. And when I started this company, the first thing I said to my partner is, Morgan Stanley spends $1 billion a year in R&D. We'll have a few million to start. We're not going to spend $1 billion. We don't need to spend $1 billion. I have no interest in competing with the Morgan Stanleys or Stevie Cohen or Renaissance Technologies or Goldman Sachs or any of them doing what they do. What we do is different. Yes, it's all artificial intelligence, but I want to explain the difference between the science we use and the science they use. And no one is applying the science that we use, and it works extremely well. So that's what has me very, very enthusiastic about this project. So what are other people doing? They're doing basically correlations and regressions. So that just means you take two data series, or as many data series as you want, take them back as far as you want, and look for correlations. And there are ways of measuring that. It's called R squared, and 0.2 is pretty low, not too much correlation, and 0.8 is pretty high. That's a pretty strong correlation. And when you find two data series with a strong correlation, you can begin to infer activity in one from the other. Now, everyone who's taken statistics in your first week of statistics classes, you're told, well, correlation does not mean causation. In other words, there's a high correlation between rain and people using umbrellas. It's highly correlated. It does not mean that umbrellas cause rain. So everyone puts their umbrella up, aha, you're causing rain. No, it's actually the other way around. The rain causes people to put up their umbrellas. But there's an example of a very high correlation, but you got to get the causation right. And that's what, then there are methods for doing that. Use third variables, independent variables. There are a lot of ways of sort of sorting that out and separating it and figuring out the causation. This has been the science of statistics for 100 years. What's happened recently, and I think Renaissance Technologies were the first to do this, but others are doing it as well, is they said, you know what? Who cares? Who cares what the correlation is? Sorry, who cares what the causation is? As long as you can find a correlation, you can trade it. So let's say, for example, that if it rains in Belgium, the price of Ford Motor Company stock goes up. Does that make any sense? No. What's the causation there? Beats me. But what if it's true? What if every time it rains in Belgium, the price of Ford Motor Company stock goes up, and the R squared is 0.85 or 0.9. Well, just look at the weather forecast in Belgium, buy Ford Motor Company stock, and the odds are very, very good that you're going to make a lot of money. So that's the breakthrough. That's what people are doing. They're saying, we don't care about correlation. We don't care about causation. We're just looking for correlation. So that's kind of level one. Level two is now with computing power and data mining, you can scour more data series than has ever been possible before. It used to be, you had a team of analysts, you had 10, 15, 20, however many talented people working for you, and you would say to one, hey, I want you to look at the correlation between real interest rates and gold, or I want you to look at the correlation between Ford Motor Company and General Motors, because that's a more sensible pairing. And they do the research and the spreadsheets and all that. Well, now with computers, you can look at everything: weather, prices, indices, natural disasters, population growth, demographic growth, you name it. You can look at everything in the world, and they just spit out these correlations. Now, when you find them, you can trade them, and you can make money, and people are making money. So Paul Jones sort of threw in the towel. One of the most successful hedge fund managers in history, Tudor Investments, a couple of years ago threw in the towel. He said, I can't compete in these markets anymore. I've got to get the automation. I've got to get the artificial intelligence. And he did. Stevie Cohen, who is about to get back into the money management business, he manages his own money, Point 72, that's the old SAC Capital. He's doing this. It's called Man Plus Machine. Man Group in the UK is doing the same thing. Everyone's jumping into this, and with a lot of success. I'm not saying it doesn't work. What I'm saying is that it works as long as it works. And the problem with this is that these correlations break down, and there's something called conditional correlation. That is, when something is correlated but suddenly becomes uncorrelated upon the happening of a condition, or vice versa, something that was uncorrelated becomes correlated upon the happening of a condition, such as a liquidity crisis. So when you're buying pairs, buy one, sell the other, based on some correlation. One looks a little expensive, one looks a little cheap. So you buy the one that's cheap, you sell the one that's expensive, you own the spread, you wait for the spread to come in because all your data time series tell you that that's going to happen. You can make a lot of money doing that, but you are short volatility. And right now, volatility is at all-time lows and has been for a long time. So it's not really surprising that people are making money doing this. The question is, what happens when that changes? And it will change. 1987, we had a one-day 22% stock market crash. 1994, the Mexican tequila crisis. 1997, the South Asian financial crisis. 1998, the Russian financial crisis. 2000, the dot-com meltdown. 2007, the mortgage meltdown. 2008, Lehman Brothers and AIG. These things happen every 4, 5, 6, 7 years. Not like clockwork, but with some regularity. We are 8 years from the last crisis. If there's a younger generation weren't even old enough to remember it, they're like, hey, it's all good. People have been around a little while, know that these things happen, but the fact of the matter is, it's going to happen again. I don't know when, probably sooner than later. It's very likely to be far worse than the last time because the system is scaled up in the meantime. And all these systems I'm describing to you, these artificial intelligence systems that rely on big data mining, and again, correlation without regard to causation. These are black box systems. I read an interview recently with the head of Man Group in the UK, one of the biggest wealth managers in the world. They created a system that did this, and they were looking at output. And the computer was just printing out pairs with R squared, so 0.2, 0.4, 0.6, whatever. And the computer was programmed to go ahead and trade the ones that were high enough to be attractive, the 0.8 and the 0.9. And the reporter asked the head of the firm, he said, do you know what this computer is doing? He said, no. We just know that it works. We don't really know. There are programmers and there are applied mathematicians and there are scientists who are building this, and there are data mining experts who are bringing up all this data. And if you get machine readable technology that actually can read plain language and read every speech in 10Q and 10K and 8K and all the rest, and 200 million Twitter feeds in real time, there are machines that can do that, and with keyword recognition they can extract keywords. So you can get more data than all the people in the world could possibly process manually. So you can get the data, you can find the R squares, you can trade them, and you can make money in the short run. But the sustainability of that, the ability of that to avoid losing all your money in a crisis, in a liquidity crisis, when guess what? All these things are going to go in reverse at the same time. All the people using the systems I described, once these correlations break down and once they go to places they've never been before, A, everyone's going to lose a lot of money very quickly. B, everyone's going to be trying to get out as quickly as they can. People are going to be running around looking for the kill switch on these computers, and a lot of times they can't find it. They forgot where they left the kill switch. So the reason I'm going on at length about this is not what I'm doing. This is not what our company is doing. It is what others are doing. They're having success. Good for them. But it's not sustainable. It has the problems I described. So let me talk a little bit about what we are doing. And by the way, I apologize for the fact that these are hard to read. I took these from an infographic, but it doesn't matter. I'll just talk you through them. So we start with the fact that markets are complex systems. Now that's important because that is not a standard model. There's very good evidence for it, but the standard models are linear. They are not path dependent, meaning they're random. So the next event that happens in markets is unrelated to the one before. Markets are efficient. Risk is distributed in accordance with a bell curve, the so-called normal distribution. Prices move smoothly and continuously from one level to another. So yes, they go up and down, but there are plenty of intermediate steps at which you can get in or out with adequate liquidity. People are rational optimizers. So these are all the pillars of modern financial theory. Guess what? Everything I just said is wrong. I just described what's behind modern financial theory, and everything I just said is empirically incorrect. It's not an opinion. You can demonstrate it. It was, maybe good 1950s science and had some intellectual appeal to the eggheads at MIT and Chicago and Stanford and University of Chicago and all these other fine schools. But actual data from markets show that that's not how markets work. They work, prices gap up. They're going like this, all of a sudden, boom. You don't get to trade at all these intermediate levels. They're up here or they're down here, and you've lost all your money before you had the opportunity to get in and out. Risk is not normally distributed. It's distributed in accordance with what's called a power curve, which explains the fat tails. The fat, Jamie Dimon embarrassed himself a year and a half ago with his annual shareholder letter. He was talking about the London whale, the market dynamic that caused the billions of dollars of losses they had from this trader in London. And he said, this was really rare. This was like a once in 3 billion year event. I thought to myself, wow, you must be really unlucky, once in 3 billion years, and it happened to you. Well, the truth is that's the kind of data you get if you assume that risk is normally distributed and you go out 15 standard deviations, which is where this event would take place. And that frequency is once every 3 billion years. But guess what? Risk is not normally distributed. These events, these extreme events, happen with much greater frequency. So all the rational economists, they take a bell curve and they draw a tail on it. They call it the fat tail. I'm sure you've all heard the expression, the fat tail. Well, if you have to put a fat tail on a bell curve, guess what? It's not a bell curve. It's a different curve. It's a different degree distribution. It's actually what's called a power curve, and the power curve fits these events perfectly, except that the power curve is indicative, it's representative of a complex dynamic system. So what are the hallmarks of a complex system? What if we were all at the University of Michigan physics department and we took a course in complexity theory from a really good professor who didn't know anything about capital markets, stocks, bonds, gold, whatever, knows nothing about it, just knows physics? What would that professor tell us that a complex system looks like? Well, the first thing, this is the middle slide, the first thing he would say is you have diverse actors. So every individual, every autonomous individual in a system is an actor. Well, so let's say we have a bunch of cavemen sitting around. If we all think the same thing, that's a really boring system. Nothing happens. But if we have different points of view, that's a diverse system. Well, what about capital markets? Well, of course, you got bulls and bears, longs and shorts, leveraged and unleveraged, short-term, long-term, all different kinds of perspectives, tens of millions of people trading these markets all day long. So we passed the first test of diversity. The second test is connectedness. So we have different points of view, fine, but are we connected in some way? Are we talking to each other? Because if we're not, again, that's an uninteresting, non-dynamic system. If we're all, again, we're cavemen or cavewomen and we're all in our caves and we don't come out and gather around the campfire somehow, there's nothing happening in that system. Even if we have diverse points of view, we're not connected. So in cave person time, you gather around the fire. Today we have Bloomberg, Reuters, Dow Jones, Internet, Google, Drudge, et cetera, email. We're probably over-connected. That's a separate problem, but we're certainly highly densely connected. So that's the second box of a dynamic system. The third is their interaction. So, okay, we have different points of view. We're connected. Are we interacting in some way? Are we transacting? The answer is, of course we are. Capital markets, trillions of dollars every day of foreign exchange, stocks, bonds, derivatives, et cetera. So we're highly interactive. And the fourth condition is adaptability, adaptive behavior, which means that if I see something in my experience that's contrary to my expectation, do I change what I'm doing? Well, I've worked in a lot of hedge funds. If you're losing money and you don't change, you're going to be out of a job. So yeah, we're very highly adaptive. It's like if you're in your apartment and you're going outside and you don't know what the weather's like, and you look outside and everyone's walking down the street with a down jacket and a thick hat and mittens, you're not going to go out in a t-shirt. You're going to put a heavy coat on. You're adapting your behavior to the information you're getting from others, and others are adapting their behavior to you. So we're 4 for 4. We have the diversity of the actors, we have the connectedness of the system, we have the interaction in the forms of transactions, and we have the adaptive behavior. If you have all 4 of those things, you are a complex dynamic system. And capital markets are not only complex systems, they're complex systems non-pareil. Other than human beings, they're probably the most complex systems in the world. Does anybody on Wall Street build their risk models or run their business on the theory that capital markets are complex systems? The answer is no. They use value at risk. They use the other assumptions I mentioned earlier. So if you have the wrong model, you're going to get the wrong result every time. So my point is, our starting place is to, first of all, understand the dynamics of the system we're in, which is a complex dynamic system. I have my famous avalanche over there on the left. Some of you may have heard me talk about the snowflake and the avalanche theory, and just in a nutshell. So you have a mountain, and it's snowing, and it's snowing, and it's snowing, and the snow is building up. And a seasoned mountaineer, a seasoned alpinist looks at that and says, you know what, that's going to fall down. That's very unstable. It's windswept. It's in the wrong place. The sun's hitting it. That's going to cause an avalanche. And yet it builds up for a while. Then a snowflake comes along, hits, lands the wrong way, disturbs a few other snowflakes. They start to slide. They gather momentum. More snowflakes join them. Then you have a chute and a slide, and the whole mountain rips off, comes down, kills some skiers, and buries the village below. Who do you blame? Do you blame the snowflake, or do you blame the dynamic instability of the snowpack? Well, you can't blame the snowflake. If it wasn't one, it would have been another, the day before, the day after. It's the dynamic instability of the system as a whole that causes the danger, and that's how we look at capital markets. We don't worry about a specific event. There are plenty of catalysts, war with North Korea, impeachment of the president, government shutdown. I could give you a lot of catalysts, but it doesn't matter. What matters is that the system as a whole is highly unstable. So we're looking at the instability build up. We have a complex system. We know there's going to be an avalanche, and then the question is, how do we use predictive analytics to predict that? Not just catastrophe. Yeah, you want to predict catastrophe, but we want to predict everyday events. By the way, this system we're building, it's not going to tell you where the euro is going to be tomorrow. This is not a day trading system. It is going to tell you where the euro is going to be in 3 months or 6 months. And that's different. There are plenty of people who give you a one-day forecast. We're going to lead you out 3 months or 6 months. We don't really think this is a day-to-day trading vehicle. We think this is a vehicle that would have appeal to sovereign wealth funds, insurance companies, college endowments, people with hundreds of billions or even in some cases $1 trillion of assets under management who farm their day-to-day management out to hedge funds and other alternative management advisors, but are nevertheless responsible for the overall performance of that sovereign wealth fund. So these are the perfect clients for us. They're not day traders. These are people who are just trying to take a long view. And if our system is telling you, 6 months ago when the euro was about $1.09, I said it's going to be $1.20 by the end of the year. It was $1.20 by the end of the year. This is the power of these predictive analytics. Well, if the system says it's $1.20 and all your managers are short the euro, you're going to lose your shirt. So you can play it any way you want, but you need to be aware of this. So I'm just going to wrap up really quickly because we don't have a lot of time. Big data is a challenge. So we're using big data? Yes. We're doing what other people are doing in terms of scanning all this data. We have partnered with IBM with their IDEA laboratory with Watson. Watson is the most powerful computer in the world, and it can do one thing that no other computer can do. It can read natural language. Actually, Watson now speaks 8 languages. They're working on more. But whether the major languages, French, English, Spanish, et cetera, it can read hundreds of millions, upwards of billions of pages in plain language with meaning. And we're working with a team of cognitive scientists, of cognitive linguists in Finland to develop state-of-the-art linguistic tools so that we can, more than just word association, my first name is Jim, my last name is Rickards. If you say, where's Jim Rickards within eight words of each other, you'll probably find me on the internet. We're doing things that are a lot more sophisticated than that. So that's what we're doing in the data area. And just to kind of add a couple things, here's what we're doing that's different. Here's what we're doing that no one else is doing. We're using Bayes' rule and Bayesian statistics. This is something I learned in the intelligence community working with the CIA. This is how you hunt terrorists. This is how you hunt submarines. This is how you hunt missing aircraft. This is how you solve problems when you don't have enough data. Because I like to say, if you have enough data, a smart high school kid can solve the problem. We get the problems that where you don't have enough data. What do you do? Well, what you do is you make an assumption. People say, oh, you're making it up. Well, you kind of are making it up, but you're doing it in an intelligent way. But then you test it, you update it every time new data comes in, and that will strengthen or weaken your hypothesis. And if it gets stronger, then you know you're on the right track. We're using history. A lot of people, oh, history, whatever, it's an academic subject. No, history is a very, very powerful teacher. We're using complexity theory, which I already mentioned. We're using fuzzy cognitive maps. That's a new branch of applied mathematics. So basically, we've got a lot of science that works very well. We did not invent any of these branches of science. Complexity theory came out in the 1960s. Bayes' rule came out in the 18th century. History has been around since Thucydides. These are all things that have been out there, but we're the first ones pulling them together, mapping them into a fuzzy cognitive network, powering them with Watson, populating our data nodes with the ability of Watson to read plain language and produce output. Just to give you one example, that kind of the middle box on the right, that blue line, there's a blue line and a red line. The red line was the market probability of a Fed interest rate hike in March 2017. So go back to March 2017, from December to the end of February, the market gave it a 20% chance. Our system gave it an 80 to 90% chance. The Fed actually did raise interest rates. We all converged at 100% the day before the meeting, but this is the power of these predictive analytics. There's a website if you're interested. We do have a capital raise at the moment. It's going very well, but if people indicate interest, we'll be sure to be back in touch with you. So you can look for us at fundable.com/Miraglin Holdings. And I thank you very much for your time and attention.